Hello, everyone. Good afternoon, good morning, and good evening. It's Joe Trevisani from Worldwide Markets. We may have fixed it, although we're not quite sure what we actually did. So I guess it's fixed. We'll start in about 2 seconds. Hello, everyone. I apologize for that delay. And I actually don't know what I did to fix it. My tech was very helpful. He suggested that I unplug and plug the headset back in, and it eventually worked, which is why techs always have jobs, I guess. Anyway, let us start. We are discussing the sterling today. But first, I want to do one thing, and I want to see pose the question before we start, and that is: do we have an analogous situation in the euro that we have? Let's get this in a little smaller section here, and that may be coming up in the euro. Okay, this is a little easier, so I can switch back and forth between charts this way. Okay, so this is where we are in the euro. Let me just get the euro screen up. Bloomberg's wonderful, but you have a lot of screens to deal with. Okay, this is the euro. And I just want to, the reason I'm posing this is because my suggestion, in fact, my idea, is that what has been pending and is now current in the euro, I think, is about to commence in the sterling. And in the euro, we're not quite before the fact, but in the sterling, I think we are. And so that's the gist of what we're talking about today. Somebody types in gold. By the way, if anyone has any questions, comments, considerations, or jokes, feel free to type them in there. If it's a joke, I'll laugh, provided it's funny, because mine are not. And anything else, I'll be glad to discuss over the headset with whatever question you want to bring up. It does not have to be specific to today's topic, although that always helps. We are not covering gold today. But I think I probably will do a webinar next month on gold. It is an interesting topic. It has far more psychological impact, or it has more, psychology has far more impact on gold than on other currencies. I'll do a little bit about gold at the end, okay? This is actually on the sterling, and that's why everyone came, but I'll be glad to talk about it a little bit at the end. What we're looking at in the euro here, I'm just going to do this briefly, is a trend that goes back almost 2 years. There's nothing like a long-term trend that gets broken to keep momentum in a particular direction. Let's zoom in on this right here. I think probably the most interesting thing about this particular today's trading is where we opened and the direction it went. It went at the line, tried briefly above for about 2 seconds and came right off. I don't think we're going to get any moves back for the time being. Now, we may get them back briefly, but I don't think we're going to get a trend. If you look this way, let's try the other side. And you can take almost any one of these points here and run them down. You can run this, which is just a channel. What am I So here we have an even more interesting setup. We've broken a 2-year trend, uptrend in the euro. It took a long time to go through. We loitered and loitered and loitered. It was not exactly a stop run. A lot of people thought, including myself, that we would see some serious stops below 77 in the euro, which had been the low for the year, right back here, I believe. Or maybe it's here. Yeah, right here. This is the low, February 3rd. That was a low in the euro. We did not really see many stops. Just a little bit of an acceleration down to 50, but that's 58. That gives us not even 20 points. That's hardly a stop run, at least by my experience, although I know volatility expectations are much diminished these days. They will return. I remember long periods sitting on the Tokyo desk when yen would do absolutely nothing. As a matter of fact, we would go out for dinner and leave the desk untended and nothing would happen. We didn't do that, but we could have, because nothing happened. We'd go out for dinner and come back and be right where it was. So we have two trends going on here in the We've broken this long trend, and we have this downtrend, which is edging towards the bottom. We did not get the acceleration from this trend, but I think we will continue down slowly. One of the things that is preventing a real drop in the euro has been the decline in U.S. rates. I could show you here, but I have my chart set up if I don't want to. No, because in fact, as far as that comment goes, if the sanctions were having an effect, the effect would be negative on the European economy. After all, they depend on Russian oil and gas. So if you have a negative effect in the euro, then what you're looking at is probably a weaker euro. In addition, if you have increased tensions of any type, the traditional term, although I think traditional turn in the markets, although I think it's diminished somewhat, is to the dollar. So both of the effects, both the psychological effect, the fear factor effect, and the economic effect of potential increase in tensions beyond where they are now in the Ukraine would probably be negative for the euro. So I don't think we're going to get any. That's probably not the reason why it's slow on the downdraft. One of the things that is happening, though, is that the U.S. economy appears to be getting better. To what degree, we can discuss. I don't think we're going to end up with a 4% economy for the remaining 3 quarters of the year. I think that's fantasy. I think we're probably going to continue as we have been with over the year, a 2 or 2.5% economy. There's an interesting writer. He's private. He writes for, you can find him on Real Clear Markets. A man's named Jeffrey Snyder of Alhambra Markets. They're a money management company. I don't think they're a hedge fund. I think they do money management, which can be the same thing, actually. And his point has been that the imposition, and it is imposition of a worldwide regimen of low interest rates, has taken the not just the volatility, but the oomph, if you will, the strength from economies. Economies need, at least capitalist economies, are there any other kinds? I don't know. We can talk about that another time. They need freedom to operate, to take risks, to be rewarded on a, if we shall say, grander scale than is permitted now with this type of rate regimen. And that's the reason, in his opinion, and it's very much worth reading. You can go to Real Clear Markets and Jeffrey Snyder and read his columns from the past couple of weeks. They're very, very good. Okay, so what appears likely now that we have finally, despite the lack of volatility and despite the lack of real movement on the downside, you break a year's trend, a year low, and a 2-year trend, and you get almost no acceleration on the downside. It's fortunately indicative of our current situation in the markets, not just. Yes, I talk about that. We'll see if the French actually do that. They seem adamant that they're going to continue to sell. I think they'll sell those ships to the Russians. That's Hollande's choice, I guess, and he'll leave it. I mean, they have the economy in France is not doing very well. Certainly out of the big economies, it's very disappointing, and I'm sure Hollande knows about that and is interested in creating jobs. So if they can get jobs by selling ships to the Russians, so they will, I suppose. With the break of this 2-year trend in the euro, this is when the the Fibonacci layout comes into play. When we get the break of a long-term trend, it is rare without some sort of intervening event that you get a reversal until there's a reason for that reversal. And just in a technical point of view, we're talking, of course, about taking profits. Well, these people are long. We don't know how many or how much they held or how long they held it. But we do know that as we go through the trend and we keep going down, you're going to get thoughts about taking profits. And that becomes the determinant in where the euro or any other currency will pause on the downside. If we look at the fundamental picture, are we going to get a reversal in the U.S. and European rate picture. Let me address that in a second because there's actually an interesting fact there. Are we going to get a reversal in the economic picture between the U.S. and the EU? Not likely. The Europeans are still reducing rates. They are still trying to create liquidity. They are still trying to get money out into the markets and to create new business by doing that. The U.S. is going in the reverse direction. This appears to me to be a rate cycle. You're going to call it, they're calling it something else, but that's what it is. One of the issues, or maybe the main issue for, and I think that's retarding the euro fall against the dollar, and I'll show you that in a second as soon as I remove this chart, has been the puzzling, if you will, fall in U.S. rates, particularly the 10-year. A few months ago, the 10-year touched 3%. It's now 2.47. It is actually almost at the low ever since the run-up last May. What is going on here? The U.S. economy is getting better. The Fed is reducing its QE, and it's going to end early, actually. The Fed is clearly concerned about some bubbles in various markets, although, of course, they're being very discreet about their warnings. Yet, U.S. rates are falling. This is not the way things are supposed to be. There was an interesting article in the Journal last week, the Wall Street Journal, detailing Chinese purchases of treasuries. What we forget, or what is easy to ignore, and God knows the Fed has been doing this very effectively, is that the rates are set in a market. The rates do not, day to day, week to week, month to month, sometimes year to year, obey what appears to be the dictates of economic-based rate cycles. In other words, if the U.S. economy is getting better, the Fed has clearly embarked on a U.S. tightening cycle. That's what end of QE is. You can call it what you want, but that's what it is. And they're talking about raising rates next year, after 6 years. Congratulations, but that's what they're talking about. All of that happening, people should be selling treasuries. However, if there is some person or some entity in the market that is more intent on buying treasuries for their own reasons than selling treasuries, then rates go down. And that apparently is what's been happening recently. The Chinese, to keep their currency weak and to weaken it because of their own domestic policies and their own domestic economy, have been buying treasuries. To a greater extent, I think they did in any 3-month period in history, if I remember correctly the article. That is why U.S. rates are going down. When and if that pressure stops, the Chinese need to, of course, in their own economy, they want to sell yuan to bring it down. To do that, they need to buy treasuries. Not the only way, but that's one of the things they can do. And so they have. And so you have I won't quite call it a spectacle, but is it irony? No, it's not irony. Irony is a literary term. I'm looking for a good word for it. Anyway, the puzzle of rates, U.S. rates going down while the Fed and the economy says they should be going up. Those lower rates are one of the things that is retarding the fall in the euro. It's not the only thing, but it's certainly one of the things that is retarding the fall in the euro. I think another thing's happening, of course, is the much lower overall volatility everywhere, and this has to do with the central bank sort of squashing of volatility, directing volatility, if you will, under its rate. All the central banks under their rate policy. The volatility is going to other places. The emphasis is going other places as to where it would normally be. Okay, so take a look at this. What we're going to do is put up the Fed funds rate for 1 second. Then we're going to talk about the sterling. I have not forgotten what we're talking about today. I do like to wander around, but okay, here we go. This is Fed funds. Oh, that's not Fed funds. Sorry. Okay, Fed funds target rate. There we go. Okay, here we go. Sorry, wrong rate. 5 years. Look at that. Okay, I love doing this. 6 months, 3 days, 1 month, 6 months, year to date, 1 year, 5 years. Thing doesn't change. Okay, let's go a little further. Let's go 10 years on the month. Okay, here we go. Okay, that's the Fed funds rate. No change whatsoever. Now, let's look at the U.S. 10-year. And this is relevant across all currencies. The generic U.S. 10-year yield. I hope there's not too much background noise here. I'm sitting in our trading room. Okay. So this is the Fed funds rate. I mean, the U.S. 10-year. Okay. Now, what do we see? This, back in May, is when Ben Bernanke announced that he might consider ending the quantitative easing program. It's been going up since then. Since then, it's traded between about 2.5 and 3. It was 3 back at the end of last year. So all it has done this year, effectively, as the U.S. economy supposedly improves, as job creation gets better, as every commentator in creation is saying, hey, we're going to a 3.5% economy, which is not happening. They're all backing down. But through that entire period of increased optimism, U.S. rates have come off. And this makes it a little harder to explain what exactly is going on. So we resorted to, and I don't think it's a resort, to the Chinese. Sort of with the Middle Kingdom, everyone's been, somebody said that people have been looking to make a fortune in the Middle Kingdom for 500 years, and they may have finally managed to do it now. Okay. So we have U.S. rates coming down, and this is one of the factors that we're talking about. Okay, well, now let's go to the sterling. I'm going to start with the look at the sterling, see where that one is, and then I'm going to go into the technicals, to the fundamentals, and we'll go back to the sterling and see if we have any set up here. I just want to find the chart here, sorry. Okay, let's do this one with sterling. It used to be STG, now they've changed it to GBP. Okay. So let's do this. So, one of the things I try to do with these trade setup webinars is to think about it and present it the way that I used to do when I was sitting on a trading desk for 15 years at Credit Suisse and Bank of Bermuda. For some of the time, I was basically a market maker. That means your job is to make prices for the market and to manage the position and to make money at the same time, and by doing so, not get fired. But when I was at my latter days at Credit Suisse, certainly in Singapore and then at Bank of Bermuda, I was essentially a prop trader doing exactly what you're trying to do. You open up sit down at your desk, you get your cup of coffee and your breakfast, and you look for trading opportunities. Now, you may or may not have trades on overnight. Most of the time, I did not. So most of what I did was day trading, varying sizes positions up to my limit. I did not really do stop hunting, although I was aware, as most people are, what are the likely levels for stops. That's what I discussed, but you can get fooled sometimes. And frankly, stop runs have been much diminished. Do I think the volatility in the market will return? Absolutely. I tended not to trade events, although on occasion I did. Usually that does not work out very well because they're very fast-moving markets. When I look at a chart like I did in the euro before, I would have assumed, as I think probably many people did, and I wrote yesterday, that there were stops lurking somewhere below 70. We did not really find that to be the case. We went down there, went to 68, actually 58, and now we're back to 70. There really wasn't anything there, which I will admit to being a bit surprised at. When you have a trend that's been going on, both, as I showed you, the trend line going back almost 2 years, and the 7-month bottom at 77. Still, there seemed to be nothing. Okay, let's take a look at the sterling. See what we got. What we have, excuse me. My mother would be appalled at that particular diction. Okay. So this particular trend has been going on for about a year. This is actually, it's exactly. So let's take that. We'll go back to a year just so we get better definition. Okay. Let's stop this. Let's do 06. Okay, so that's 6. This is the trend we have right now. Okay, so let's take this here. Sorry about that. Here we go. Okay, so this is the trend we're dealing with right now. This is a fundamental and a extremely tradable. I assume that everyone, if you're looking for fundamental trends, this is one of the best. Goes back a year. I think we may see this reversal in the euro, but we'll wait on that. Certainly that's what the Europeans would like. So what we have here is a trend that goes back more than a year. It is not yet at the breaking point, but look how close that it is, which is why I find sterling and why I scheduled this particular topic. This is the break point right here. This is the trend line. The trend line is about 70 points from here. That is something you want to get involved in if you get it through that line. Another thing that's true is the tops here. Take a look at this. Okay, now this is not 100% accurate, but you have enough incidents through here, and isn't that nice? They coincide more or less, and if we go out further, that is tomorrow, if we don't get any action today, and the next day, you're going to have both the resistance becomes support line and the year trend line coinciding in about the same place. One of the things I always look at when I consider charts and the different types of indicators, we can look at some indicators in a bit. I'm not as enamored of indicators because most indicators simply show deviation from the mean, and the basis of almost all of them, not all of them, but almost all of them, is reversion to the mean. So if you get too far on one side or the other, negative or positive, or from the zero line that's been set, they're just telling you that it's likely to go back the other way. So even though there are a number, shall we say, many numbers of indicators, they're all essentially telling you the same story. However, there are people who put lots of faith in them, and if you look at the psychology of the market, I always think of sort of as different categories. Somebody likes trend lines. Somebody else likes support resistance. Somebody else likes Fibonacci's. Somebody else likes indicators and moving averages and on and on and on. So the more of them that are alive, the more of them that are indicating the same thing. And that goes for time frames as well. Trend lines, long-term trend lines, I don't think anything is really useful less than dailies. However, when you're looking for inception points, stop loss points, things like that, that's where you can get into, I think the term would be granular, although I don't really like it very much. You get into shorter time frames. I don't think there's anything useful, particularly below an hour, but if you want to, take a look. The more of these time frames, indicators, formations, resistance, support lines, the more of them that line up, the more people you have. Think of that everyone is, every indicator's got 10 people behind it in a trading market of 100. The more of them you get, the more likely it is to happen. Why? Because everybody's going to do the same thing when you get to that level. AU, I'll just tell briefly. I didn't look at AU to prepare for this webinar because we're doing sterling today. But just from from the fundamentals in the Australian dollar has become almost an adjunct to the Chinese economy. There are how many Australians and how many Chinese? Maybe that's the reason. And there are, although the Chinese are doing their utmost to keep the economy humming. The Chinese Communist government in Beijing, they deal with the Chinese people. And China's history is of rebellions, unrest, overthrowing the government in Beijing, a particular dynasty. And it's very, I think, instructive to view the Chinese communists as an imperial dynasty. with all of the attributes that fit Chinese history and Chinese culture, overthrown and replaced by a different dynasty, or as the phrase used to be, they have lost the mandate of heaven and someone else, another dynasty, will rule. The bargain for the Chinese has been, we deliver economic growth and riches, wealth, the possibility of wealth to the Chinese people, and they do not demand other rights. And that's largely been the case. So I think that the Beijing government is actually quite fearful of unrest. And in fact, if you do some pretty rigorous searching on the web, you can find many more instances of unrest in China than ever make it to the mainstream media. But you have to search a bit. Anyway, so the Australian dollar is very much tied to what's going on in China. The most indicative fact, I think, of what's actually going on in China, and I'll do this 1 second and I'll show you. The great thing about this Bloomberg terminal, former mayor, I live in New York, and although he was a bit of a nanny, especially at the end, his company is brilliant. Okay, this is the Chinese yuan going back to 2009. It's interesting. Let me stretch it back a little bit more, okay, and I'll show you what's going on. I will deal with the cable. What do we have here? This is the Chinese yuan against the dollar. Chinese yuan is a managed currency. I think that's probably true. I think for all of the developed world, and China is more or less part of the developed world now. The developed world has never had a country with a falling population. We're about to. It's one of my favorite topics because I think it drives almost everything, and it's certainly an explanation of what's going on in Japan for the past 20 years. And I think you do not get dynamic, expanding economies when you have a shrinking or static population. But that is another topic. Look at this Chinese yuan. This is utterly a managed currency. What happened here? The world blew up, or was about to. What did the Chinese do? They stopped revaluing their currency. The currency stopped becoming stronger from mid-2008 until mid-2010. The yuan didn't move, essentially, after having fallen dramatically, or actually increased in value, the number per dollar going down for this period right here. So that tells you it is a completely managed currency, which everybody knows anyway. Okay, it goes down through this period right here. Suddenly, the beginning of this year, the Chinese start devaluing their currency. And this, by the way, as I showed you earlier, is also the period where inexplicably, if you will, the U.S. 10-year rates and other rates start to fall. Now, the Fed at that point probably didn't want them to rise too much further or too fast. Did Ben Bernanke call up, I forget the head of the Chinese central bank's name, and say, hey, could you guys buy some more? No, not likely. But this is no coincidence. So if you're looking for an estimate of what's actually going on in China, many people don't trust their statistics by and large. I don't. The Central Committee comes up, they need 7.5% growth. They get 7.4, or they need 7.4 and they get 7.5. Whichever it is, it's probably a good deal off from what's actually going on. This, I think, tells you more than anything else about what's going on. Okay, the Chinese are worried about their economy. And the more this goes up, if this starts to rise up to here, you should get very worried. And the Australians should get very worried. And the Australian dollar will come off hard on that because that's where it gets its growth from. Okay, back to the sterling. Okay, sorry. Okay, I wonder if we can still get it with SWIFT STG. Let's see, that's the old way of calling it. No. Wow. I'm dating myself with that one, sorry. Okay, GBP. Here we go, historical line chart. Which debt to GDP are you talking about? The only one I know that's high that's close to that is Japan. Okay, so this is the sterling. We're going to take this out we're going to put this in. We're going to put it into candles because I think candles make a better picture. We're going to do this to 06. Okay, here's the line. Come on. Here we go. Okay. Okay, that's the beginning. This is the one we just put up with the resistance line here. Right about when you get resistance lines like this, I like to put them if they're anywhere close to a round number. I like to put them at the round number. You do get often, especially in the Japanese yen. We used to trade those in Tokyo all the time. We'd get close to a figure, would do something, we'd go back the other way. I remember back in the mid to late 90s when the Japanese were intervening in the currency markets all the time. Guess what they were trying to do? No rewards for this. They were trying to weaken the yen, of course. Sound familiar? What are the Chinese trying to do? What are the Chinese doing? They're weakening the yuan. It seems like mercantile policies are still very much on the minds of most policymakers. I think the reason is because there just isn't that much else. And national governments are responsible for the national economy, and they respond to the needs and wishes somewhat of the national population. And guess what? If they can improve, especially for the Chinese, the outlook of the economy by increasing exports, that's what they're going to do. And that's exactly what the Japanese have done. Now, you can make the argument, of course, that as Abe had, and I would make that argument as well from a economic point of view, from a purchasing parity point of view, from almost any point of view you'd like. There's zero sense of a Japanese economy up until recently trading in the 80s on the yen. But it was there, and it was a problem. So anyway, let's go back to the sterling here. So we have a potential, I think, here for a serious break. Now, whatever you want to take the let's do this. Let's look at the comparison between the UK and just got to find the right currency here. Here we go. Okay, this one right here. Sorry about all the screens, but I like to flip around, and I really can't do it when I make it the size of the whole monitor. This is an interesting screen, an interesting overlay. Europe and the UK. I wouldn't say that the UK, that the benefit to the British economy. Here, take a look at this one. I know I jump around a lot. Okay, this is the. I didn't put the US up here because the US does its GDP statistics annualized quarterly. I remember hearing someone say recently that's one of the silliest ways of looking at an economy, and I think there's a lot of truth to that. Annualized quarterlies. So we look at the U.S., the British, most of the rest of the world doesn't do it that way. They do it year to year, and they do it quarterly. So whatever the quarterly growth or expansion or decline in an economy was over the prior quarter, that's what you look at, not what it would be if it were for the whole year. So that for the U.S., the annualized first quarter is negative 2.9%. So is the U.S. going to actually just decrease 2.9% for the whole year? No, of course not. I mean, it could, but it's not going to. So then what is the point of projecting that particular figure across an entire year? It tells you almost nothing. It's like the Fed's, my favorite bête noire of the Fed is their core inflation rate. I'll be glad to pay a core inflation rate when I don't have to put gas in my car and I don't have to eat. But until then, it seems kind of pointless to look at that, especially when, their rationale for it is that they're transitory inputs into the economy. Transitory was the last time anybody in this country, at least around New York, paid less than $3 a gallon for a gallon of gas. It's been quite some time, so it hardly seems transitory. since one of the larger impacts on food prices, aside from weather, of course, are energy costs. If energy costs stay high, then food costs stay high. So the idea that these are transitory inputs is foolish. The Europeans, the ECB and others, seem to have a better, more realistic take on that. At any rate, this is the comparison of GDP with the UK. This is quarter to quarter. I didn't put the US up there again because they do annualized. This is quarter to quarter. UK is white. The EU, EMU, right? Not the EU, the EMU, because the Brits are part of the EU, but they are not part of the EMU. There's a great argument to be made for the independence of currencies for large economies, and here's one of them. And Germany, the strongest nation in the EU and the EMU, is in green. And you can see that over the past year, Britain has outperformed the EU, the EMU, by a wide margin, and for a certain amount of time, it has outperformed Germany. Germany, the world's perennial export powerhouse, whose economy of 77 million people, I forget how many exactly, until last year was by value the world's biggest exporter. It was simply recently passed last year, I think, by China, which has 1.3 billion people. Germany has 77 or 80 million people. But the value of exports from Germany were the highest in the world. That doesn't mean that their economy is larger than the U.S. or anything like that. No, the U.S. is not that, comparatively to the size of its economy, it's not that large an exporter. At any rate, so this is the trend, especially over the last year or so, that has been driving the sterling. For up until about here, which is about a month ago, the euro and the sterling were more or less going in the same direction. Yeah, I'm looking at the shape of the lines here, not the comparative. And they started diverging right here back in May. The euro has started to come off because of the comments, pressures, and also rate cuts from Mr. Draghi and the ECB. And the British economy and Mark Carney, who was actually, I believe, a Canadian from the Bank of Canada, have started to talk about increasing rates. And that's where you get this divergence. Even though the emphasis, if you will, now both of these, of course, are affected by changes vis-a-vis, because both of these charts are against the dollar. Sorry. So both these are against the dollar. So if we look at these, you can see that the movement in the sterling has now started to change right here. And that's what we're looking at before. If that's the case, here's another chart. Look at this one. This is the UK and EMU unemployment rates. It's almost double in the Eurozone. So there isn't anything here that gives one credit. Now, another thing that's been talked about, of course, is that that under Cameron, who was elected in 2010, May, I think, 2010, the British government caught a lot of grief from many commentators, certainly here in the United States, where they decided to have a different policy, the quantitative easing and all of the expansionary Fed policies. The Brits did not quite do that. They certainly did not pump as much money into the economy as the U.S. did. And they were far more attentive to reducing expenditures because they said that that would free up the economy. It has turned out to be true, although no one is talking about it much right now. The Europeans did not have a choice in doing it, and they had other problems. So all of the divergences between the European economy and the UK economy were sort of became important about May or so now. So let's take a look again at where we're going with this. Now, I know we're going to have to end shortly, so I want to make sure that we get in some views on what to look at for the sterling. Okay, let's take a look. First of all, let's take a look at some studies here so we can see exactly where we're going to go with these things. And these are the kind of things that I would look at. Let's put up an RSI. I'd rather put a longer period. So let's put in a 55-day period. And let's see if we end up with the type of overbought situation that would indicate it. Let's just red line right here. So it was overbought more up here, of course, exactly what you'd expect, but it still is indicating an overbought situation. Let's take a look at another one. Okay, we'll go back here. And we will let's end this one, and we'll do another one. Okay. Put up an oscillator. There are a zillion to choose from here. I will put up the one that I like. Okay. We'll put up another chart. Okay, this shows a slightly different view, and that probably is due to most of the recent movement. Okay, let's add one more. The famous Bollinger Bands. Okay, and we've seen, again, in these, we've seen a turn down. Now, does that mean that we have missed the movement here? Based on this particular strategy right here, in this period right here, and that's very recent for the past 2 weeks, probably, but based on the trend line, I would say no, we have not. Okay? So let's look at some other positions. Now, where might we put our positions on? Let's do it here. The obvious point, of course, is right here, somewhere beneath the line. Or in fact, if you're looking to make the move, I would generally try and front run it. You could wait till down here. What I would do is I would do it somewhere around here, right above the line, see if it accelerates through, and then leave your stop back above the line wherever you started from. But either way, whether you start here or here, the formation that you're looking at, of course, is this line right here. Where might it go? How do you choose these things? Well, the easiest thing to do, and this is certainly true of the euro in its current position, and what the sterling might do if it does break this line, is this. You just look at the Fibonacci's, because, as I said relating to the euro earlier, the thing that happens when people look, no, I think we're actually going to get a break of this line, and there are two reasons. But the basic one, the trading reason is simply because we have movement down, and we're going to get, once we get close to it, the sterling is a lot more volatility because the points are worth much more. If you trade against the dollar, as everybody does, you could also trade the euro sterling. So you get much more movement, you get much more stops. A fundamental view is that the European economy, the EMU economy, the continental economy, is still Britain's biggest trading partner. And if, I will take one, give me that 1 second. And if you look at the direction and the concerns of the Europeans, then they are essentially going to drag down the British economy. Britain doesn't have any place else to turn to sell its goods. So if the European economy, and you've seen this top right here, you have a similar view, although it's delayed in the sterling because it's reactive. It's not coming from the euro. It's not coming from the Bank of England. as the European economy declines, I think it will take the British down with it. And that is why, from a fundamental point of view and from a trading point of view, you're going to get most likely a fall of the pound through its trend line and down. So where does it stop? Obviously, the first place it's going to stop is all the way down here, 62. That's a very nice run. When people look to turn profits, one of the first things they turn to is the Fibonacci levels, and that's why they have indicative sense. They are very useful when you're looking for places to turn. Now, of course, everyone is looking for the same turn. So if you do happen to be short through this run here, front run it. Don't wait till it gets to the level. Put it 50 points above. And if you get a sense that people are doing the same thing, then move it above. Remember, your job is to capture. If you capture 50% of a move, you're doing brilliantly. If you look to do any more, be very careful. Okay, I will, on request, just take a look at the Aussie, and then we will stop. Put this up here. Okay. Put it in candle. Yes, I would agree with you. It looks to me that through here, this period right here, that's exactly what you have, right? You could say you have two shoulders over here, or somebody's holding up a finger. But yes, that's exactly what it looks like. For the reasons that I spoke about earlier in relation to China and the world economy in general, I think that the Aussie is looking a little rich. Let's take a look at a really long-term trend in the euro. We like reversion to mean. I don't know what kind of reversion we're talking about. Have there been absolute changes in the world economy? There have been. But let's take a really long view on this. Let's take a 20-year view on the Aussie dollar. It's not so long ago that the Aussie dollar was trading almost half of where it is now against the U.S. Has there been enough of a change in the world economy to bring it back to those levels, or to prevent it from going back to the levels? I think it probably has. But if you are, well, put it this way, 0.5 is a long way from 0.93. So if you think that you're going to get some reversion to the mean, there is a tremendous amount of movement possible, I think, on the downside in the Aussie. But yes, I would say you're looking at head and shoulders in that one. Okay, folks, I thank you all for attending. I'm sorry we got started a little bit late. I hope we covered enough so that it was interesting. I'd like to answer questions. If anyone was bored, I apologize. And we will do this again twice next month. If anyone has any comments or questions, I will put my email address up there. I'll be glad to answer them. And we will choose our subjects. In fact, if anyone likes to suggest topics, I will be glad to do it. Just send me an email, and because I choose the topics for FX Street, and I'll be glad to deal with them. We may deal with emerging markets next time, but you have to cover more currencies when you do that. You have to actually do a lot more background work because you're dealing with more economies. Okay, I thank you all very much, and I hope you have a great day wherever you are. Take care.